Hello everyone, welcome to today's class. Today we will be talking about the cost of taxation and it's the application of the theory of consumer surplus, producer surplus. We have covered this topic in the previous lecture. I will quickly review this concept again because we will be using them in this chapter extensively. So I will do a quick review of previous chapter and then a quick introduction to this chapter, and then we will continue with our main topics. So in the previous chapter, we talked about consumers, producers, and the efficiency of the market. I will only highlight the five main summaries of that chapter, and then I will start a new lecture. So what we have learned was that consumer surplus equals buyers' willingness to pay for a good minus the amount they actually pay. Consumer surplus is the difference between how much a consumer is willing to pay and how much he or she actually pays. And the area below the demand curve and above the price is basically the consumer surplus area. So the area which is below the demand curve and above the price level, it is the area of consumer surplus. Now we will move to producer surplus. Producer surplus equals the amount sellers receive from the goods minus the cost of production. So it is a difference between the cost of production and the price of that product. So whatever remains is basically the producer surplus of that specific good. And it is the area below the price and above the supply curve. So if you want to see where the producer surplus is located, it's basically below the price and it's above the supply curve. So these are the two concepts that we have discussed. And we also said in our last lecture that an allocation of resources that maximizes total surplus is said to be efficient. So we said an efficient market is the one which maximizes the total surplus, and we said that total surplus is consumer surplus plus producer surplus. A market is efficient when these total surpluses are maximum. And that happens, for example, in a free market. If you imagine any type of good, or if you imagine the graph of demand and a supply in a free market for any type of good, in that market, basically, when there is no taxes, for example, the total consumer and producer surplus or the total surplus is at maximum, and that is an efficient market. So we define that situation as an efficient or an efficient market. The next main point that we have discussed last chapter was the equilibrium of supply and demand maximizes total surplus. So when there is an equilibrium of demand and supply, basically this situation maximizes the total surplus. So that was our another main conclusion from previous chapter. And the last thing that we have talked about was that market does not allocate resources efficiently in the presence of a market failure, such as market power or externality. We said, like, if there is a negative externality in a market, or for example, if there is a monopoly, that basically is not an efficient market. And one of the reasons is that that affects the producer and consumer surpluses, and that is not an efficient way of managing an economy. So these were the five main points of the last chapter. Now we will start with the content of chapter 8. And chapter 8, we will apply these concepts into the context of analyzing the tax system of a given country, or we will see what happens when a government imposes taxes on certain goods or services. So the title is the application, so we will see the applied side of this concept and we will analyze the cost of taxation. So basically, taxes are a topic which is heavily debated among economists as well as politicians, and it has been a topic of discussion since a long time from in the history, and still it's a topic of discussion. So there is no one concrete answer to say, for example, this is the efficient or that's the best tax rate that should be. And because everyone has different opinion, different idea of the taxes, for example, how much should the rich people be taxed, or how should the poor people be helped with the government policies. These concepts vary from person to person, from politician to politician, and also from economist to economist. So this concept of taxation is something debatable. It has been under debate for a long time, and also there is no concrete answer to say what an efficient tax system would be. But of course, um, our focus is like to have an efficient tax system, and that's how this chapter will help us understand some of the costs of imposing a tax and also the benefit that the government receives in terms of tax revenue. So we will see and find what are the costs of taxation and what are the benefit side of the taxation, and how government policymakers could use these concepts to make an efficient tax system. Um, there is also the concept that some level of taxation is necessary. So government needs money to run the state, to run the police force, to run the army, to provide basic services for everyone. So there should be some level of taxation that will generate revenue for the government. But as I said, people argue how much the tax rate should be. Tax on a good affects its price and quantity sold. So whenever a government imposes taxes on a certain good or services, it basically affects its price. So the price of that good changes, and also the quantity of that good being sold. So what happens is, if for example, if there is a tax on petrol, um, so of course the price of the petrol will increase, but also people will buy less petrol because it's much expensive now. So any tax will affect the price of that product, and it will also affect the quantity sold of that product. So tax on a good affects its price and quantity sold, and the sources of supply and demand divide the burden of tax between buyers and sellers. And then we will see if a given tax basically it affects either buyer or if it affects the seller. So we will see it depends upon which sources of either supply or demand is affected by this tax. For example, we will come to the example later, but um, what I mean to say is that some taxes are on producers and some taxes are on the consumers, and that affects either supply or demand. But basically, at the end, this burden of taxes is shared between buyers and sellers, and that affects on the elasticity of the demand and supply curve. Uh, okay, we will come and discuss this more in detail during this chapter. It's just an introduction to this chapter. And we will also talk about how taxes affect welfare. So we said in the previous chapter that total surplus is a good indication of the welfare. And this part of the book is also about welfare economics. So we will see how taxes will affect the welfare of the population, and we will use the means of consumer surplus and producer surplus to analyze these concepts. So how taxes affect welfare? We will compare cost to buyers and sellers and the revenue the government raises. So we will see if there is a tax, how basically that affects the welfare of both buyers and sellers and also to the government. So of course government is also receiving a revenue once a tax is imposed. So obviously government is receiving money, so it's on a positive side. But the buyers and sellers, they are negatively affected because they have to pay these extra taxes when they purchase a good or services. Okay, so the main conclusion from this chapter would be that the cost of taxes to buyers and sellers typically exceeds the revenue raised by government. So it's like a general conclusion that we can make is that whenever a tax is imposed, so the cost it results to buyers and seller is much more than the revenue that the government is receiving. So for example, to put it in a simple terms, if the cost of taxation is 10 euros, for example, 5 euro is paid by producers and 5 euro is paid by the consumers, the government revenue will be less than 10 euros. And we will talk and discuss how it happens or what lies behind this conclusion. So that was the very introduction part of this chapter. There are 2 or 3 main topics. So the first main topic is the deadweight loss of a taxation. Okay, so before I go to the technicalities of it, so I will put and explain the deadweight loss in simple term. So what happens is that whenever government imposes taxes, it distorts the market. So it's a distraction in the market and it changes the supply and demand curve. And as a result, uh, some people will not buy that product because it's more expensive, because there is more taxes on that. So that's the consumer side. And also producer, because they are receiving less prices because of the taxes, they will also produce less of that good or services. So what happens is that whenever there is a tax, buyers will buy less of that product and producers will also produce less of that product. Why? Because the prices has increased as a result of the taxation. And that basically what happens is that some people, both buyers and sellers, will leave the market. So there will be a distortion in the market and some people will actually not buy that product anymore, or producer will not produce that product anymore. And that is basically a deadweight loss, and it's a loss for both sides, and nobody is winning that. So it's a loss and it's a dead loss. So nobody is getting anything out of it. And we can see that, and we can show it basically with the help of producer surplus and consumer surplus, and then you will understand more easily if you see that in the graphs, and I will refer to the graphs as we continue through this chapter. So I will quickly open the box. I can refer to the graphs as well. Okay, so that was the main explanation. So the main lesson from the deadweight loss of a taxation is that the impact of a tax on a market outcome is the same whether the tax is levied on buyers or sellers of a good. So if a government imposes a tax on a certain product, the burden uh, is basically shared between buyers or seller. It doesn't matter if the tax is on buyer or if the tax is on the seller. So both of them will share the total burden of the tax. The second point is that the elasticity of supply and demand determines how the tax burden is distributed between buyers and sellers. So who pay how much of these taxes? It depends upon the elasticity of supply and demand. If you are not familiar with this concept, I will suggest that you search elasticity of supply and demand in Google or whatsoever, and then you will get the concept.